Welcome to a new episode of BizTechTalk. Today we have a brilliant entrepreneur, Wooyoung Joe, who is a co-founder of a startup, TallyUP, valued at $40 million. He will share his insights on ups and downs of startup journey and, of course, his expertise on building successful startups, investments, and fundraising. So let's get to it. Wooyoung, we are very pleased to have you, and thank you for honoring our podcast with your presence.
Thank you. Yeah, great to be here. Yeah, I would say not that, it's not like broken out yet, but yeah, happy to be here and share any insights that might be helpful for people. Yeah.
Thank you very much. So the first question is an easy one. So who is Wooyoung? How did you build your way to where you are today?
Yes. So hello everyone. I'm Wooyoung. I'm 27 years old, and yeah, I would say how my kind of entrepreneurial journey started was that I kind of initially got lucky being in the right place at the right time. I met the right people. In 2017, while I was still in college, I dipped my toes into crypto and into Ethereum. And I got very lucky because I started building a mining farm and mining Ethereum early on. And that gave me kind of my initial pool of capital to invest in startups. And that's how I got started investing in startups. And, TallyUP, which is my current company, was one of those companies that I encountered during that time. Yeah, so that's how I got started. Yeah.
Okay, so you are saying that your company is TallyUP. Can you give us a little more information about TallyUP? What is TallyUP? What is the story behind TallyUP, and what is the mission of TallyUP?
Yeah.
What it sets apart from other companies?
Yeah, definitely. So to put it simply for consumers and users, TallyUP is just a game that you can play, these fun, addictive, and simple games to win real prize money. Mm-hmm. And I would say what's different or what sets it apart from a lot of the other kind of games out there is that one, there is a real prize money element, similar to, game shows on TV, like Who Wants to Be a Millionaire or Slumdog Millionaire or something like this. What sets it apart from a lot of those other kinds of games is one, unique game design, and that we've designed very fun, uncheatable games where anyone can play and compete and have fun on a repeated they can play it over and over again. And we've taken a lot of inspiration from a game like poker, where it's semi-skill, semi-luck, but mix that with very approachable and simple kind of intuitiveness and simplicity of something like rock, scissors, papers. So you can kind of think about them as a 1 to 2 minute long poker game. So nobody can kind of solve the game or cheat the game, because if you were to create a prize tournament with a game like chess, it would just be about your ranking and how good you are, right? No matter if I play 1,000 games against Garry Kasparov in chess, I would lose all 1,000 games. But, in something like poker, where the odds, let's say, are, the best players may win 60% of the time, and you can develop an overarching strategy. But, even a noob like myself can beat somebody like Daniel Negreanu, out of luck. So that's how the games are kind of structured. And the other innovation is in how the game economy works. So we redistribute the revenue that the players generate for the game to the players as a small but real kind of financial stake in the system. So let's say, for example, you download the app and you play a few games, you watch a few ads, you generated, let's say, a couple cents for the system. The system gives you that money and lets you basically so-called gamble it against each other. We don't like to use that word, and our lawyers don't like that word. But we basically let you kind of gamble and have fun with each other for free. But it's small but real money that you can kind of play around with to make more and more money. And it's a combination of the transparency and how the model works and how the games work that create this really fun and unique experience for players.
Nice. Okay. So users can stay motivated because they can get prize money.
Yes.
And besides that, you say they need a little practice and a little luck to maybe win.
Yeah.
Nice. What are the games? What kind of?
They're all built in-house. There's 4 mini games. We're building more now. Yeah, but they're our own games. So It's nothing like anything else out there. Yeah. And the users like this model because they know that they start with, small but realistic amounts of money. So let's say, for example, when you play something like Omaze or Lucky Day, where it's like a daily scratcher, it's completely random. And it's kind of just like a black box where the system picks a name out of the hat and says, oh, you won the money. And they have no kind of like accountability or reason to kind of like prove to the users that they even had a chance in the first place. Whereas in this model, users know that they start with a few cents, which is realistic. And they have kind of control over their destiny and how they play the game, if they lose, if they win. And it's clear to the players how we make money as a system or like as a business. So the model is like a lot more transparent and a lot more fair. And that's one of the feedback that we got from our users.
Oh, nice. So how did you come up with this idea? I mean, did you have this model for a while in your mind, or was it more of an outside experience that pushed you to build this kind of game?
Yeah, so this is actually like the product idea was originated by my co-founder, Jason, who is also our CEO. And he had so this is his kind of like the economics and all of this was his idea. And it was actually, there was an early iteration of this product or this idea in around 2001, 2002 in Web 1, right? So this app was a web app. And back then it was called moola.com. Moola like money, MOLA.com. And it went really viral because, there was like a lot of users and like Michael Arrington from TechCrunch wrote about it. Like a lot of like companies called it like a lot of love from the media. It failed for different reasons, but I would say that it's like kind of like a second iteration of that idea that was really successful back then. But right now the environment is a lot better for this product because, there's mobile, there's programmatic ad network, and a lot of like advancements like cryptocurrency, Web3, that make this product a lot kind of like more suitable for now, and this kind of technological environment than it was say 20 years ago. Yeah.
It's fascinating. So now can you share some numbers related to your startup? You already told us to me, but besides that, what is your annual revenue, or how many rounds of investment did you raise, and how much was it? Or it can be number of users.
Yeah, of course. I would say in terms of the stats for investment, we've had a seed round and an extension round, and we've raised around $8 million so far from very good Web 2 and Web 3 gaming investors and crypto investors. Our lead investor was Makers Fund, which is a top gaming fund in the world, with participation from other funds like Play Ventures, Everblue, as well as crypto institutions like Polygon, Aptos, Amber Group, and many others, and many good angels like David Helgeson, who's the founder of Twitch, Unity. Our current valuation, as mentioned, is at around $40 million. And our user stats were at around 1 million registered players, I think. Yeah, well, at least like million something downloads on Google and as well as on App Store with very, very good ratings. Daily active users were at around 15 to 20,000 daily active. So still not gigantic, but it's a reasonable amount of numbers that kind of like validates whatever data that we have. And around 200,000 monthly active users. Yeah.
Okay, nice. Did you mention revenues?
Revenue, I think we are making around a couple $100,000 worth of ad revenue every year. Yeah.
It's just ad revenue.
Right now it's ad revenue. There's also things like sponsorship, which is a little bit different from ad revenue. And we're building out in-app purchases very soon. So that will be another revenue stream. Yeah.
Oh, nice. So, well, it's growing.
Yeah, yes.
So I understood that you handled quite a lot of your company's main streams, like, I don't know, marketing, go-to-marketing strategies, and social media growth, and maybe partnership management. Can you share what were like your best decisions that took your company to the next level? And in general, when did you start the company? How long it took you from start to where you are now? And what were like the game-changing decisions, let's say?
It's a very long question. I would say that one of the most important things is that, like, I think a lot of people, especially who appreciate product, like kind of invest too much time perfecting the product. I think there's two mistakes. I think one, you have to build an MVP just to test your thesis, and you have to release it in the market. And I think one of the things we did well was that, like, we released the product in a not so perfect form, and you just need to spend enough on user acquisition just to like get user numbers in, and you then iterate from there, right? One, you shouldn't spend too long just building the product without releasing it to the market. You should release it, get real market feedback, even if it's small in terms of the sample size. And two, like, I would say don't spend a lot of money on like a leaky bucket. So what that means is, like, if your unit economics is not figured out, and you are losing money on each user that you make, each user that you bring in, right? So say, for example, your cost of acquisition per user, or like what we call CAC, is like $2, but your LTV, which is like the lifetime value of the user, is $1. You shouldn't be spending money. You should be building, you shouldn't be spending money on acquiring more users that are just going to lose you money. Like, you're not gaining anything from that exercise. So at that point, you should dial down, like, in my opinion, you should dial down the UA a little bit, and until, like, you should figure out how you're going to flip this unit economics, whether it's through kind of viral growth and like referral mechanics that brings the CAC down, or you need to introduce like new revenue streams or new ways of monetizing to increase the LTV. Because until you figure that out, it's very difficult to get like the next round of funding. Yeah. So I would say those are kind of the two things. And actually on the user acquisition side, it's a little bit hard because, like, once you see your users grow, you want to keep seeing it grow. And I think, like, overspent a little bit on user acquisition at some point. But yeah, that's something, I think, a lesson that I would change. But building, testing, and getting real market feedback, and like iterating from there, that's, I think, like an approach that, yeah, a lot of startups should take.
Yeah, that's, I guess, very, very important point, because we actually have one potential client at the moment. Mm-hmm. He came through a network. So we learned that he has been building a platform for over a year now, and the MVP wasn't released. And we were a little surprised because the platform that he mentioned, it could be released in 4 months.
Yeah.
Yeah. And he's been working for 15 months probably.
Yeah.
Yeah. And I guess it is one of the like real mistakes, because 15 months ago and now is different.
Yeah.
Already different times.
Yeah.
So you could miss out on that, and it's really valuable to get actual feedbacks, because we also had an experience of our own when we released the MVP really quickly, like 2.5 months to 3 months. But we didn't research well before. So when the actual users got it, they didn't get the platform, most of them. So then we understood that we had to pivot.
Yeah.
So we divided the platform into different apps, according to that, to those feedbacks, because we understood that it's not going to be used.
Yeah.
We thought that it was great, and we understood the value of the actual user feedback.
Yeah.
That it was crucial.
Yeah. Yeah. One of the concepts that I really like is that you should iterate, and you should also fail fast. Like, if something's not working, you should, like, that applies in startups and in life. I think you should, like, you try something, and if it doesn't work, like, that it doesn't work, and like you need to have a thesis, and you need to have a way to determine, okay, this works or this doesn't work. And you have to kind of like get to that point fast. And also with regards to like the 15-month thing, not only are you losing, like, I don't know if this person is, building it as a side hustle or they receive funding and there's a burn rate. I would say like 15 months, like, the market can also change drastically. So whatever you were building that was relevant back then may not be relevant as relevant, right now, especially if you're building in somewhere like crypto, where like one minute this is the hottest thing in the world, and then the next minute it's like not so sexy. So yeah, definitely like market feedback is very, very valuable. And you should put your product out, even if it's not perfect, so that you can get the feedback. If you do need to change things or you do need to pivot, you can do that early on without over investing in a certain direction. And it's, there's a really good story about Slack. So Slack didn't start as kind of like a messaging remote working app. I forget what the initial product was, but that I think is one of the best examples of like this team that just knew how to iterate. And like Slack, like the product that we use now was actually kind of like an internal tool they were using. And then people just really liked it. And then they were just like, okay, why don't we just build this as a product? And, that's a great example of like, just like you get user feedback in terms of like what's working, and you just scratch that itch, and you go towards that direction of what's working, and you like iterate, and then it just finds more and more product market fit because it delivers more value to the users. So yeah, I would say like you really don't know how the market's going to respond to your product until you put it out there. And like just overthinking and like kind of like over engineering your product and investing so much into it like pre-launch, I think it's not a great strategy. Yeah.
All right. Thank you.
Yeah.
Thank you. And I am a little curious about the marketing part of your product. For example, in games, we also had some idea. Actually, we built a couple of games, but we didn't know like a good market strategy. Shed a light on that part. Like what works in gaming.
So marketing and getting users, I would say it's different for like different product categories, right? So how you market a B2B SaaS product is very different from a consumer app. So our go-to-market strategy would be very different from something like Zapier or like some like B2B SaaS product. So in terms of a consumer product, I think first you need to understand like the basics of user acquisition. So you need to have user acquisition channels like Google, Facebook, IronSource. It depends on what platform your product is in. If it's an app, if it's a web app, that kind of determines what user acquisition channels you have available that you can use. And then from there, you kind of, I think you need to have like, I think every startup or every consumer product needs to like have like a solid base of user acquisition kind of channels that you can buy good users from. But it's not a great long-term strategy unless you really found product market fit to just put money into something like Google, right? And so like your product, what we call a K factor, which is like the virality of the product, which is also used in like, measuring like the virality of like a virus, right? It's like user acquisition channels, you need to have a baseline understanding of how they work and like what's worthy of like, or like what's a fair price of getting a user for you guys, what makes sense. You need to have that base understanding of like how user acquisition works on a baseline. But I think that's not enough. Like your product needs to, I think, inherently be to an extent viral. It needs to have referral mechanics. It needs to have even just like some kind of like shock factor or something like that's really interesting. That like once you inject that initial kind of like base of users, you'll get like that's just like a starting point, and then it blows up from there. So you should have like a base understanding and then some kind of reason why the product will blow up, because if you just like, you're not going to get there just by pouring money.
I guess outbound marketing doesn't get you viral.
I think just paying for bought users, which is user acquisition, it's a necessary tool to either get your initial cohort or like initial base or flow of users, but you're not going to win just by pouring money into that thing. You can win if one, there is like some kind of organic like product feature or like some kind of viral factor, whether that is through a clever referral system or whether it's just like the product is very viral, right? Like let's say, for example, Be Real or Snapchat, those kinds of products, they are like inherently viral. So they just need like a small injection of like user base for it to grow very, very quickly. Or you, as a consumer product, you figure out your unit economics. So what we just mentioned in terms of something like your CAC to LTV ratio, which is one of the most important unit economics. It's basically how much money are you paying to get a user and how much money are you getting from that. So let's say, for example, like if you can flip your CAC to LTV like to like a 2 or 3 ratio, right? Let's say, for example, for every dollar you spend getting a user, you can make $3. Even if it's not instant, you have like over, let's say, like a couple weeks or like a couple months, you can make back like 2-3x the money that you spent. Now you have a formula for like, now you have a viable product business model, right? And so like that's also the point at which like funds will invest in a Series A, because you now have this engine where you can just pour money and it will just grow and get more market share. And so until you figure that out, like you're not going to win just by getting new users. Like there's something fundamentally like uncompetitive in your product. Either it's not providing enough value to monetize it enough, or it's usually that, because like user acquisition isn't like, it's not magic. You just have to learn how it works. Yeah. So I would say, and at that point, once your unit economics are flipped, you can raise a Series A, or you can also get like kind of leverage financing. So there's a lot of companies that would look at your economics, like your unit economics, and they will loan you money to fund your user acquisition activities. But they will look very closely at your unit economics. What's the repayment period per user? Like when do you break even on a user, and when does it kind of like generate positive revenue, and all like how long that cycle is. So yeah, there's a lot of avenues, but I would say what will never work is for you to just pour money into like advertising a product that isn't working. So you should be kind of like resourceful with your capital that you have, and not waste too much of it on just like growing an app that's like not found product market fit. Yeah.
All right, thank you. Very valuable points that you touched right now.
Yeah.
So let's get to investment part of
Sure.
the startup. I guess it is one of the pain points in startups in general. So you said you raised 2 rounds.
Yes.
And it would be good to know how you got there, how you got from the beginning. I mean, from the beginning of fundraising journey, what kind of investors you, let's say, you reached out, or maybe they found you, how the initial relationship started.
Yeah.
What did you do so that to convince them to fund your startup? And as an angel investor yourself, you can tell us from the investment point of view, how do you see and what are the factors that make you invest?
Yeah. So, when you think about, let's start from the investment side, right? Yeah. When you look at something and it doesn't look hot, you're not going to be compelled to invest, right? And that's how hype and these hype cycles work as well, right? So if you look at a deal and you're like, it's inbound to you and like they're really desperate for money, as an investor, you're like, okay, why are they not getting investments from other places? And it's like inbound deals are not as hot, right? Whereas like as an investor, like that matters, right? It's like when I'm forced to invest because this thing is so hot and it's gonna go, like I really want to invest. Whereas like if something is just coming to me and it's like, please give us money, I'm like just like psychologically like less inclined to invest. Now obviously you have to analyze the product and you have to analyze the team and all of these things, but like that's how investor psychology work, and that applies to institutions as well. So VCs, I know some VCs whose MO is basically they will never invest in an inbound deal unless they have to chase a project that is hot. They won't invest. So they only invest in deals where they fight for their ability, like they fight to be on the cap table because the deal is so hot, and they just want to get in there, like and like kind of like be a part of that deal, you know. So that kind of, that's a bit extreme, but that kind of goes to show like you have to kind of figure out a way to make the investors act, because just asking for money, it's going to be pretty hard. Like unless you have like things that are really like backing kind of like that, like strong reasons why investors should invest in you. Let's say, for example, you are a Nobel Prize winner and like you have this super innovative like tech product, like this new like kind of like compression algorithm or something like that, that just like by the data, the tech is awesome. Yeah, those ones, if you talk to venture investors that understand the tech, or just, you know, like if you are somebody like that, like that's like super impressive, you could probably just raise. But for the most of us, like, you know, there's a million startups, right? And everyone thinks their like product is the shit. And like it's, yeah, I would say like you have to understand like investor psychology a little bit, and how like you have to think like, how do I create FOMO for this product? And a lot of the times I would say, yeah, so like from my perspective as an investor, that's what you invest in, right? So on the flip side, as a startup, what you should do is you should think about how to kind of generate like FOMO, or how to generate ways for investors to act. And another thing that's important about investor kind of like dynamics is that for an investor or like a VC, gathering more information about you over time is better for them. So like there's like, because the more they learn about you and your progress and your product over a more extended period of time. Let's say, for example, I'm a VC and like, you know, we had a conversation, I think it's interesting, but I'm just like, okay, keep me posted, I don't want to act now. That like over time, as you kind of give like share updates and stuff like that, that to an extent de-risks my investment, right? Because I know more about you and your product and all of that. So kind of the default for a lot of VCs, unless they want to like act like quickly, is for them to just, you know, lay back and just like see how it goes. And the longer time passes and the more updates like they get more information. If it's failing, then great, they didn't make a good investment, you know, a poor investment. If there's really strong and good updates, they get more conviction, right? They understand and they just get more information. So yeah, like VCs will drag their heels a lot of the times because it's the best thing for them to do strategically, right? It's like, just wait and see how it plays out. The company never receives funding, then, you know, maybe it's just not very hot. Or like, you know, if they have suddenly like a really strong lead investor, then that's a huge like data point, right? And now it's like hugely de-risked. And so, you know, they can make an investment more comfortably. Usually like investment would come in, like there would be a lead investor, and finding like that lead is going to be like one of the most challenging. But once you get a very strong lead investor, like we did with like Makers Fund, like all of the, like they would then bring in a lot of like co-investors to participate in that round and fill up the rest of the allocation. And usually the more reputable and strong your lead investor is, it will be very quick to fill out the rest of the round. So say, for example, you have a $4 million round, the lead invests like, you know, 1.5 or 2 million. It's going to be very quick to get like, you know, the rest of the 2 million, because usually the lead investor, you know, will do most of the due diligence. They will kind of like back this thesis, and then like all of the follow-on investors will come on. So yeah, like I would say definitely, like if possible, like the best place to be, I think in fundraising is like, if there is some kind of like hyped viral kind of like moment going on for your product, it's very like, you will get a lot of inbound, in my opinion, from good VCs that are staying on top of like product trends. Or like if you can build and iterate without incurring any burn. Let's say, for example, if I'm working as an engineer somewhere and I have like a co-founder as an engineer, we're both like working and we're just building a product on the side, and that product finds product market fit, then that's a really strong position to raise money from, right? And so yeah, I would say those are the few things. But then again, also like it also depends very highly on market conditions. If the market is very hot for that sector that you're in, it's very easy to get investment, right? Like AI right now is really hot. And so if you're an AI startup, it's probably much easier for you to raise. But I would say that like you got to have a lot of conversation. There's going to be a lot of people dragging their heels. There's going to be a lot of people kind of like waiting and seeing. But there's like a new VC fund that's coming out every day, or like hundreds, or like there's like thousands of like VCs that you probably never spoken to. So I would say like just have a lot of conversations, and it's a grind, and it's also a numbers game, right? It's like yeah, we didn't know we would meet our like lead investors, but like we did. So you just have to keep having more conversations, because there's always like people that you've never spoken to, that may see what you're trying to build, and that may like develop like a strong thesis behind you as a team, and back you guys. Yeah.
Okay, so the point that you said, that the more they know you, like the longer they know you, or the longer they have like information about the company, because at first they may not tend to invest at first if it's not very hot topic, as you said. But if you keep them updated, and they see some kind of positive progress, let's say, does it open like opportunity for them to get interested in it?
I guess yes. The thing is, I think with VCs, it's like, it's very like, if it is not like a yes on the first call, and there's like, just like really strong alignment on the first call, it's really hard to convert them into taking action unless they're forced to, right? So usually I think like a lead investor would kind of see it from the get-go, and like you would have a very strong call, and then you would have multiple calls, for due diligence and things like that. I would say like if there's like an investor and you've spoken to them, and like they're interested, but they want to be kept posted, I don't think they would act unless they have to. So let's say, for example, like you found a lead investor, then all the people who are kind of what we call sitting on the fence can be pushed over, right? But it's I would say near impossible to push over like a VC that's just like sitting on the fence with time, right? With just like, unless you have like a major update. Let's say, for example, like you've been talking to this VC, and suddenly like your product like takes off, then they're again like forced to jump on. Yeah.
How was your journey? I mean, your fundraising experience.
Fundraising is always hard because you're asking for money, right? And it's always hard, but that's, I would say like that's one of the most important roles of a founder and the CEO. Yeah, like our journey was tough, but yeah, in the end we found the right partner. We found a great lead investor, and then like everything else from there was like much more smooth sailing. Yeah.
How long did it take for you to get from the decision, from the, let's say, okay, we are going to fundraise, so from that decision to actually finding the lead investor?
I would say we decided to fundraise the moment we started the company, and so that would be around late 2018, 2019. And then I think it took us a year to find our lead investor. And so during that time, some people were full-time. I think some of the co-founders were full-time. Like some were not taking, salary. I think we had 1 or 2 engineers back then, and all of their kind of pay came from the co-founders. And so it was like self-funded. If I were to do it again, I think a lot of us would keep our day jobs and then just like, build the product and see where it goes. And then like if we do raise money, then everybody kind of turns full-time, because it's a big risk for anyone to kind of work on something full-time, like when there's no backing, and like you can't, like it can't support you. Yeah, so it was hard, but I think like again we spoke to a lot of investors, and then we spoke to a lot of investors, and we had a lot of people who were sitting on the fence. We had some people who said straight up no, because it either doesn't fit into their model or their thesis. A lot of funds are thesis driven, so if you're building a consumer product and you're talking to a SaaS fund, like B2B SaaS fund, like they're not going to invest even if they think you're an awesome, founder, or you have an awesome team or an idea. They just simply like, they don't have the mandate to invest in something that they didn't raise their fund for. So I would say like kind of like, you have to talk to like the funds, obviously, that are investing in your area. Yeah. And then you just have to have a lot of conversations, and then you just have to break down your pitch of like how things went, what investors are responding well to, what are the strong points, and you have to iterate on your deck, and have many of those conversations. And yeah, at some point sparks will fly, and you'll like raise a round, hopefully. Yeah.
Oh, great. So yeah, fundraising is kind of very hectic and I guess a little stressful race. Yeah. One of the stressful parts of, in general, in building startup. So if we go into, in general, developing startup, what were the like non-obvious lessons that you learned? Like, we all know that, okay, startups are ups and downs. You have to be resilient and stuff. But are there like insights that you got, but that were not known to you before, but it was quite important and maybe even game-changing for you?
Yeah, I'd have to think about this a little bit, but I think you have to find a way for your product to go viral, and you have to, just building a good product is not like, oftentimes it's not enough, because it's not always the case that a better product takes the market, and a lot of it kind of comes down to like strategy, like growth hacking, viral growth, and you have to get scrappy, and you have to get creative, and you have to do something new. You can't just copy and paste what worked for other people. And that applies for everything that we're talking about on this call as well. Like, like any advice like that you hear or that I'm giving now, it could be relevant for me. And that has been my experience, but it might not apply for you, So I would say that like, you have to get creative, you have to get scrappy. You have to try new things. If you're just doing what everyone else is doing, there's very little chance that you'll succeed. And so I think like the non-obvious thing was that like, I think there were maybe some opportunities for us to be more creative and more daring in terms of like marketing, growth hacks and stuff like that, that I think we I think we should have been a bit more daring. Yeah. And we are going in that direction now, but yeah, I think it's very easy for products to like become irrelevant. So you have to kind of like, you have to like know how to put yourself out there and kind of like put it on people's radar and like, create like viral moments for your product. Yeah.
I guess it's something new that I've heard, for example. Yeah, good product, and besides building good product, of course, it is important to put the word about your product out there.
Yeah.
And if nobody knows it, then
Yes, exactly.
Okay.
Exactly.
So in general, if we talk about, I mean, you've been in gaming industry, in crypto, I guess, industry for quite a while. So where do you think this industry is going, and what are the major trends? If there are founders or entrepreneurs that want to jump in to gaming industry or crypto maybe industry, what are the main trends that they need to follow?
I would say in terms of gaming, I mean, I think gaming is always going to be a popular sector. I think like it's only growing, in my opinion. I would say like definitely explore new kind of like newer media, like VR I think is going to come up. VR, AR, I think is really cool. Yeah, I would say like gaming trends, I think like gaming is a little bit like movies, right? A lot of the times like game storylines like Halo or Last of Us gets turned into movies or TV series. So I would say a lot of like game development, it's kind of like, I can't give so much advice to it because like it's kind of like making movies, right? If it's good, if it's a great experience and it's fun, like your game will be great. Like that's just like, it's a creative process. So I can't really like have too much input into that. Whatever genre, whatever kind of like type of game, whatever media it's in, it's possible to create an awesome game, just as it is possible to like make an awesome movie about anything in the world, short film, long film, documentary. So that like gaming, I would say it's like as a field, like it will continue to grow. I think people are becoming more and more connected, more and more in their phones, in their screens. Yeah, and just I think gaming will continue to grow. Yeah. So it's a good space to be in. I don't think I can give any specific advice in something that is such a creative process. In terms of crypto, I think it's definitely like it comes in cycles. So you have to understand like when a good time to build and when is it a good time to raise and when is it a good time to launch your tokens, and you have to have a little bit of like crypto native understanding, and you only get that through actively participating. Otherwise you have the risk of like being tone deaf, or you don't understand like the market trends. And the thing with like crypto, I think, is like the market trends change so quickly. So if you don't like have your foot in it like fully, then you then you probably like there's a strong chance that you'll like miss the trend. Yeah.
So how do you stay on the top of the trends and changes?
I gamble and lose money online. Yeah.
Okay. You see, right now, well, at the moment, especially in England here, we are experiencing the country and not only a recession. So did it somehow affect your business?
I would say market downturns they're always like, they're not a great thing. Like it's like, but it's also not that bad if you're building a startup. The reason why I say this is because there's always people with money. There's always funds that are looking to deploy. And there's always shrewd funds that are looking to deploy in a bear market where the valuations are a lot more reasonable. So, like Amazon and like LinkedIn, a lot of these like great companies out there, they were funded like in the bust or in the aftermath of like the dot-com bubble. Mm-hmm. So there are always good investors that are looking for great products and great teams building amazing things. So I think like it's not as market dependent. Obviously, if you're building like a hyped up, building in like a very hyped sector, it's good. Like that definitely plays to your advantage, and you may face like, more difficulties raising if like the hype dies down. So there's that. But I think in general, like, yeah, there's always investors deploying in whatever field looking for great teams. And so it's always possible to get funding, like regardless of the market condition.
Yeah. Okay. Yeah, that's good to hear.
Yeah.
So we're going to finish off with some more personal, let's say, questions.
Mm-hmm.
So how did you end up in London? And what was your, in general, like background?
Yeah, so I ended up in London because I was studying here. I studied computer science and business. And yeah, I kind of decided to just stay here because our team is mostly remote and we have like, we have the ability to work fully remotely. So yeah, I decided to stay here because a lot of my friends, my friends are here, some of my family is here. So that's why I decided to, live and work from London. Yeah.
So you lived and worked in America as well, right?
Yeah.
Okay, I see. So how does your, in general, routine look?
I'm a big fan of Andrew Huberman, which is, he's very popular among tech bros. So it's very typical of me. But yeah, I like to start my morning with like an hour of cardio. So, whether that be yoga, most of the times it's walks. So I would take like an hour long walk. If it's nice and sunny outside, I would kick it outside. If it's not, then I would just get on the treadmill for an hour. And some days I would listen to audiobook, and other days where I feel that I need to kind of like unpack and process my thoughts, or there's a lot going on, I would just not listen to anything and just like walk for an hour, and just listen to like your internal dialogue. And then I have my coffee, and then I just get right to work. Yeah.
Nice. So if you were to say one like personal trait of yours or characteristic of yours that you move on, what do you think it is? I mean, what is?
I would say character is built through hardships, and I think some of the kind of philosophies that I really kind of like take to heart, and that's really helped shape kind of like navigating through a lot of the difficulties in startups. I think the startup environment it's like, it's the same with everybody's life. There's a lot of uncertainty, But I think in startups, it's even more amplified. There's more uncertainty. There's more responsibility. Being a founder with like people on payroll, and like you're responsible for like the livelihood of people, and you're responsible for your community and all this stuff. And there's so many moving parts and so much uncertainty. Kind of like one thing that's really helped me is like kind of stoicism, and like kind of, you know, understanding like kind of controlling yourself, and understanding like what's in and what's out of your control. And yeah, I think that it's not really a quality, but I think it's like kind of a philosophy that I think really helped me. Yeah.
Thank you. Thank you for sharing your experience and giving advices that entrepreneurs may find very useful. If you have more questions, please leave them in the comments, and we will leave a little more information about yourself maybe. And thank you for joining. It was our pleasure.
Thank you. Yeah, thank you for having me. Yeah.
Thank you.